April 2nd, 2025, 9:17 a.m. Eastern. Trading floors are settling into the midweek rhythm when an urgent White House flash crosses the terminals. President Trump has authorized a tariff barrage on Chinese imports, duties of up to 125% on a catalog that spans aerospace alloys, EV batteries, and next-gen semiconductors. The justification? Economic security. The intent? Force Beijing back to a negotiating table Washington claims has tilted for decades. Futures flip from green to crimson in seconds, liquidity thins, and the bid-ask spreads on blue chips widen like a storm front. Beijing's reply is just as swift and surgical. Before New York's closing bell, China slaps 84% tariffs on U.S. farm machinery, medical devices, and processed foods. The speed of the counterstrike signals a hard truth. The world's two largest economies have entered an escalation loop with no obvious off-ramp. April 3rd, capitulation hour on Wall Street. The Dow opens down 1,637 points, its sharpest intraday gap since the 2020 COVID crash. Program selling kicks in. Every bounce is met with heavier volume on the downside. By the close, market depth has evaporated and the VIX volatility gauge is screaming north of 45. April 4th, the rout turns into a rout plus. Another 2,200-point slide for the Dow, a 6.2% dive for the S&P 500, and the Nasdaq, home to the mega-cap techs that powered the post-pandemic bull run, officially sinks into bear market territory, down 20% from its recent peak. What's driving the stampede? Two catalysts: supply chain anxiety and margin compression. Tariffs threaten to snarl flows of precision parts and rare earth elements vital to advanced manufacturing. Higher input costs arrive just as headline inflation is finally cooling, squeezing corporate earnings from both ends. The IMF, the OECD, and Wall Street's biggest houses rush out flash notes. A drawn-out tariff war could shave 0.8 to 1 percentage point off global GDP in 2025, enough to stall job creation across 3 continents. April 9th, political triage. Under growing pressure from exporters, farm state senators, and even defense contractors worried about component costs, President Trump steps to the West Wing podium. He announces a 90-day tariff pause for most allied nations but keeps the full weight of the duties on China. The message is dual-track: reassure global partners, keep the vice grip on Beijing. Markets breathe, briefly. That afternoon, the S&P 500 posts a 4.6% rally, its biggest one-day gain since 1945. The Dow claws back 1,890 points. Yet traders quickly label the move a sugar high. The core disputes, forced tech transfers, industrial subsidies, and market access barriers remain untouched. Over the weekend, quant desks and asset managers rerun their models. The takeaway is sobering. Without a concrete deal by early July, the tariff machinery can restart at full throttle. Monday open volatility is back. Treasury yields sink to record lows, classic flight to safety, while multinationals fast-track contingency plans to relocate suppliers out of China, a pivot the Boston Consulting Group estimates could cost more than $150 billion over 5 years. Consumers are already feeling the tremor. Supply contracts for smartphones, appliances, and apparel are being repriced. Retail chains warn of price tags creeping higher just as wage growth flattens. Central banks face a policy conundrum: how to cushion a slowdown without reigniting the inflation they've spent 2 years fighting. Lesson of the month: global finance is a hair-trigger system. One policy stroke in Washington or Beijing can ricochet in milliseconds through Frankfurt, Tokyo, and Sao Paulo. The 90-day ceasefire is a diplomatic breathing space, but it also spotlights the fragility of an interlocked economy where a single tariff headline can vaporize trillions in equity value. Eyes on 3 fronts through July: negotiating rooms in DC and Beijing. Any hint of compromise on IP or subsidies could reset risk appetite. Business confidence surveys, watch PMIs and CapEx intentions for early signals of a second-half investment freeze. Third-party actors, the EU, India, and emerging market blocs looking to reroute trade lanes and court-dislocated supply chains. In a hyper-connected world, Every tariff and every concession reverberates. We'll keep deconstructing chart by chart and data point by data point how this high-stakes trade chess match is steering the trajectory of the global economy. Ladies and gentlemen, keep an eye on the indicators. The White House's new tariffs are already leaving their mark on three pillars of the U.S. economy: farms, auto plants, and big tech, and the effects are being felt from the grain silos of Iowa to the labs of Silicon Valley. Agriculture, the Corn Belt under strain. China's retaliation, a 34% tariff on U.S. soybeans, corn, and beef, hits the chief customer for these goods head-on. With $60 billion a year at stake, every percentage point of extra cost wipes millions of dollars in competitiveness against Brazil and Argentina. Grain elevators in Iowa and Nebraska are reporting record stockpiles, and co-ops say the farm gate price has fallen as much as 18% in barely 4 weeks. According to the Department of Agriculture, if sales to China contract by only 20%, the average Midwest producer's net income could plunge by up to 40% before year-end. The picture revives memories of 2019, when the previous administration rolled out a $28 billion direct aid package. Today, however, federal coffers face a larger deficit, and Congress is debating whether a similar bailout is politically viable. Automotive industry. Detroit slams on the brakes. Manufacturing is feeling an equally unsettling jolt. Goldman Sachs has trimmed its domestic sales outlook for 2025 by nearly 1 million units, citing higher costs for steel, aluminum, and microchips, inputs that now cross the border with surcharges. The math is straightforward: an extra $2,000 to $4,000 per vehicle over the next 12 months. The major assemblers, Ford, GM, and Stellantis, are reshuffling launch calendars. Some electric models will be delayed while supply contracts are renegotiated. The Manufacturers Association warns that the mix of higher costs and softer demand puts up to 45,000 jobs at risk, from stamping plant operators in Michigan to seat suppliers in Tennessee. The added cost also threatens to slow electrification. Batteries, already up to 40% of an EV sticker price, depend on metals largely refined in Asia and now facing new customs duties. Technology Silicon Valley under pressure. At the corporate summit, the so-called Magnificent Seven, Nvidia, Apple, Tesla, Microsoft, Alphabet, Meta, and Amazon have seen roughly $2 trillion in market cap evaporate since the escalation was announced. The core fear is a supply chain fracture that for decades has assembled components in Shenzhen, refined rare earths in Jiangxi, and mounted motherboards in Taiwan. Apple and Tesla, with production lines and sales deeply rooted in China, are weighing shifts of some manufacturing to India, Vietnam, and Mexico, a relocation that carries transition costs, workforce training, and above all, time. Meanwhile, an iPhone could rise by more than $100 and a Model Y by up to $5,000, squeezing the consumer price index just as the Federal Reserve tries to tame inflation without chilling the economy. The convergence of these sector hits sketches a slowdown scenario. Lower farm exports drain foreign earnings and depress rural investment. The auto slump reduces demand for domestic steel, plastics, glass, and software. Big tech stock slide dense pension portfolios and 401k plans, cooling spending among upper-middle-income households. Congressional Budget Office economists warn that if the dispute drags on, GDP growth could be shaved by up to 0.7 of a percentage point in 2025, enough to erase more than 900,000 projected jobs. At the same time, the Treasury yield curve is flattening, a sign that investors are seeking safety and pricing in weaker growth ahead. In Washington, the trade team insists tariff pressure is needed to force concessions on intellectual property theft and Beijing's industrial subsidies. Yet China's countermeasures, which could extend to rare earth export restrictions or controls on critical battery minerals, add systemic risk, a tech choke point that could slow the energy transition and the advance of artificial intelligence. The State Department, mindful of interdependence, is exploring cooperation with the European Union and Indo-Pacific allies to build alternative supply chains, but it warns such a reconfiguration would take years and require multi-billion-dollar tax incentives. The trade war between the United States and China has morphed from a bilateral arm-wrestling match into a tectonic force shaking the very scaffolding of global commerce. Over the next few minutes, we'll break down, point by point, how this escalation threatens to redraw supply chains, jeopardize world growth, and resurrect ghosts of past crises. Global economy impact staggering numbers. The World Trade Organization has sounded every alarm. Its economists project that, if the tariff confrontation persists, trade between the two superpowers could collapse by as much as 80%. Translated to the entire planet, that commercial hemorrhage would mean roughly a 3% drop in global trade, the sharpest slowdown since the 2009 recession. But the blow doesn't stop there. WTO models foresee a sustained 7% decline in real-world GDP over the medium term, equivalent to erasing in one stroke the combined economies of France and Italy. Two engines drive these figures: the loss of efficiency as value chains are forced to fragment and duplicate, and a plunge in corporate investment amid tariff uncertainty. International reactions cracks in the consensus. In Berlin, Chancellor Olaf Scholz pulled no punches, calling the U.S. tariff barrage a direct attack on the international trade order. Germany, whose economy relies heavily on exports, sees protectionism as an existential threat to its industrial model. Brussels, meanwhile, has stepped up talks with Tokyo and Canberra to reinforce pacts that keep Asia-Pacific trade lanes open. Behind the scenes, the EU is even exploring an offset mechanism to shield its car and machinery makers from a looming subsidy war. Beijing's counteroffensive more than tariffs. China hasn't stopped at a 34% duty on U.S. farm and manufactured goods. The Ministry of Commerce has triggered export controls on strategic minerals, gallium and germanium, indispensable for semiconductors and renewables. The message is clear: Beijing has levers beyond tariffs that can tighten the global supply chain even further. Rare earth exchanges in London and Shanghai already show futures up as much as 40%. And chipmakers in South Korea and Taiwan report critical inventories for the year's final quarter. Paradoxes and collateral damage. The shockwave spares no hemisphere. Emerging countries that thrived on globalization, Vietnam, Mexico, Indonesia, see chances to attract investment diverted from China, yet fear being trapped between two blocks demanding exclusive trade loyalties. The World Bank estimates that currency volatility in emerging markets has doubled since the escalation began, raising the cost of servicing external debt and draining dollar reserves. At the other extreme, commodity exporters, Brazil, Australia, South Africa, enjoy higher prices but warn that a global recession could crater demand and slash fiscal revenues. Echoes of history, the specter of the 1930s. Parallels with the Great Depression are hard to ignore. In 1930, the Smoot-Hawley Act raised tariffs on more than 20,000 items. The ensuing chain reaction slashed world trade by nearly 50% and deepened the crisis. Today, the sophistication of value chains multiplies the risk. A tariff on a power chip made in Chengdu can stall an electric vehicle assembly line in Ohio, and in turn, a wiring supplier in Spain. Interdependence is now so deep that one broken link can idle entire factories. Macro outlook and room to maneuver. Central banks are walking a tightrope. The Federal Reserve and the European Central Bank fear a prolonged supply shock could reignite inflation just as they start to tame it. Raise rates to curb prices and credit costs soar, hastening the slowdown. Cut rates and fresh inflationary pressure builds. In parallel, G20 finance ministers weigh coordinated fiscal stimulus but run up against record public debt levels after the pandemic. The diplomatic clock. The window to avoid a point of no return is measured in months, not years. Washington and Beijing have announced technical rounds to review IP standards and industrial subsidies, yet negotiators admit the political climate, U.S. elections on the horizon and a backdrop of tech rivalry, makes visible concessions hard. Meanwhile, the WTO urges restoration of its dispute settlement mechanism, paralyzed since 2019, to provide a legal channel that tempers the lure of unilateral retaliation. What began as a balance of trade adjustment has become an earthquake threatening the global economic architecture. Potential trade collapse, investment freeze, and financial volatility paint a scenario that demands urgent diplomacy and multilateral solutions. Without them, history may not repeat itself, but it could rhyme perilously with crises we once thought were behind us.